Next, we look at merchandise operations. To this point, we have done the business transactions and presented financial statements for a service company. That is a company that provides a service. A hairdresser or a mechanic, they provide a service, not a product. We're now looking at companies that sell products. They are referred to as merchandise companies. That is, they buy in goods. They do nothing with them except put a price tag on them or put them on a hanger, and they sell them. Now, of course, they sell them for more than what they purchased them for. So, for income measurement for a merchandise company, we have, instead of service revenue, we have what's sales revenue. Now, if I sold something for $100 and I purchased that something for $60, well, the cost of what I sold is called the cost of goods sold, and that is $60. We subtract that to get the gross profit, and from the gross profit we subtract operating expenses to arrive at net income. Now, for a service company, the income statement was simply service revenue minus operating expenses. And that equaled net income. For a merchandise company, though, it's sales revenue minus the cost of goods sold equals gross profit. And from gross profit, I then subtract operating expenses such as salary and rent to arrive at net income. Let's try this brief exercise on income measurement. Presented below are the components for Brown Company's income statement. Find the missing parts. Well, A would be 71,200 minus 30,000, so that would be 41,002. Now, B, gross profit minus operating expenses equal net income. So therefore, B would be 17.9. So make sure you understand the relationship here. It's sales revenue minus cost of goods sold equals gross profit minus operating expenses equals net income. Now C, revenue minus the cost of goods sold. Well, C would be then 38,000. And once I have 38,000, subtract operating expenses from 38,000 to give me 29,500. Therefore, operating expenses would have to be 8,500. And lastly, E. Well, I don't know what their sales revenue is, but I know the cost of goods sold was 71.9 and the gross profit was 109.6. Those two together then means that E must have been 181,500. And lastly, F, I take 109,600 minus operating expenses. F is 63,400. The difference between merchandise operations and service companies, of course, is that merchandise operations purchase in inventory. So we have a new account, an inventory account. This is an asset account. Now, that account is for every item that the business purchases in that is going to resell. Now, some companies only have one type of item, like a car dealership. But other companies can have thousands of items, like a merchandise store or a variety store. All of that is under one account called merchandise. Now, when we talk about merchandise, there are two types of systems that we do for accounting. That is, if the type of thing that we have in inventory can be recorded each and have separate records for it, then that's a perpetual inventory system. When I buy, I have a record of what I bought in as inventory. When I sell, I know how much I sold it for. Now, of course, many companies want to move towards a perpetual system, and that's why you have barcodes on many items. That tells them exactly what the cost of that inventory was that they're selling to you. Now, contrast that with a perpetual or periodic inventory system. We do not keep records here. What we do is we calculate what the beginning inventory was. We add what we purchased during the year. Those two together give us the goods available for sale. Then we subtract the ending inventory to give us the cost of goods sold. Now for the balance of this, most companies use perpetual inventory system because it's simpler and it's more accurate. And that's what we will use when we record these transactions. Now here's a purchase invoice that we purchased. Okay, so we are Sock Stereo. We purchased from PW, and the date of the purchase was the 4th of May, and the terms were $210 net 30, and free on board shipping. Okay, what does all that mean? Well, first of all, we are going to record this journal entry. We purchased inventory, so we debit inventory. And because we have terms with this company, then we have an account with them, so the credit is accounts payable. Now, FOB, shipping point, and FOB destination are different. Now, they're very important. What the seller is saying when they say free onboard shipping is, I am selling to you these items, and I will put them on my shipping dock. You come and pick them up. So in that case, you have to pay the transportation. And that's an added cost to purchasing inventory. In the other situation, if the seller says that they are going to sell the products to you, free on board destination, then the shipping cost is paid by the seller. And that shipping cost is in the invoice of the items you purchased. So if I have to pay for the transportation in addition to the inventory I purchased, then I make a journal entry. In this case, on May 6, I had to pay $150 in freight charge. I debit inventory $150, and I credit cash $150. Now, when I purchased items to be resold, some items are defective, and I may want to return them. So when I have that and I return the items to my supplier, the journal entry is I reduce what I owe, debit accounts payable, and I reduce my inventory, credit inventory. Now you'll notice on that invoice that the terms were $210 net 30 and 30. That means that I have 30 days in which to pay them the $3,500 that I owe them. And if I decide to pay them earlier, within 10 days of May 4th, then I can take a 2% discount. And so therefore, assume we pay the balance of $3,500 on May 14th, the last day of the discount period. Well, I cancel my accounts payable, so it's debit accounts payable. I don't pay them $3,500. I pay them 98% of $3,500. And this is a 2% discount. And therefore, I reduce the cost of my inventory